Hello, this is Jason Wink, and today is September 18. It's about 3:45 p.m., so 15 minutes before the market is ready to close. And the reason for my video update today is, first of all, it's been a little while. The second reason is today the Federal Reserve Chairman Ben Bernanke started speaking about an hour or so ago. And the market really liked what he said. In fact, if I take this chart, I turn it into a shorter term chart, you can kind of see, once it loads anyway, this huge reaction. So you see this big spike right there, that was the reaction to the Fed's speech today. Now, as far as what did he say to make it pop up so much, basically the big fear, especially for the bond markets, lately has been this idea of the Fed tapering. The idea behind tapering is the latest version of quantitative easing from the Federal Reserve was the Fed buying bonds. They were buying about $85 billion a month, largely of mortgage-backed securities. And this particular round of quantitative easing, one of the things that it's done is it's helped keep interest rates low. So that was kind of the whole idea, was keep interest rates really low. By keeping rates really low, it would ease up the money supply. Also, obviously, if you're buying a lot of those bonds, you're creating a lot of liquidity, and that would help stimulate the economy. So that was the idea. Back in May, and you kind of see where this happened. This was the drop that happened back in May. That was when the Fed came out and said they were going to start tapering the purchase of those bonds, meaning they weren't going to be buying $85 billion per month. They were going to start tapering, and the hint was that it would happen late in this year, 2013, or early 2014. So today, the Fed came out and said that we are not going to suspend the bond buying program, so the tapering is not starting right now. The market really liked that because it basically is injecting easy money into the financial system, makes stocks go up, drives interest rates down, which actually makes bonds go up, creates a bunch of debt, which makes commodities go up because the dollar is going down in value. So things like gold and other commodities are skyrocketing today. So a very good day to be an investor. It almost doesn't matter if you're in a conservative portfolio or an aggressive portfolio, a commodities portfolio. Just about everything is up 1% or more today. And you can see that's exactly what's happening with the S&P 500. It's up 1.2% as I'm speaking. The other thing that it's done is it's pushed the S&P back to an all-time high. So the current value, which is at 1725, is the new all-time high. So if it closes there, it'll be the highest close in the history of the S&P 500. So a pretty good feat. What I'm showing on this chart, I drew in a couple new trend lines and I took away some old ones. This chart, for those who've been following my video updates for a while, this is an S&P 500 daily chart. This looks at the last 12 months, so it's 1 year worth of market history. Each line, the white lines, is an up day, so the one that's still yellow means that today is not finished yet, so that's the last bar. Whenever you see a red bar, that means it was a negative day. And it's really interesting because there was a point here just a couple weeks ago where the market went down something like 9 out of 13 days. It was kind of a rough little patch, and then it turned right around the 1st of September. The market's been up every single day but one in the month of September. So here we are, September 18. It's been an awfully good month so far. There's a couple lessons we can learn about that. One is, I know personally I've had a whole bunch of people panicking kind of back in May and June and then back again in August about a market correction. And it certainly was a possibility, but then you have news like this and it makes all assets go up. So if anyone panicked and they sold all their bonds, now they're probably regretting it because they likely sold at the all-time low, or not all-time low, but certainly the past 12 months low or year-to-date low, and they haven't seen the recovery that's starting to happen in fixed income. And if someone's a stock investor, hopefully they stayed in their stock investments throughout the year. I know our tactical asset allocation models have had us 50 to 60% invested, and this is just the growth investments in the U.S. stock market. So it's been a pretty good run for the stock portions of portfolios, as long as you stayed the course. If you're buying and selling every time there was a 4 or 5% correction, it really hurts. So when we're in a good long-term uptrend, it's important to stay the course, even when there's a shorter-term correction. So the new red lines I drew in here, this is sort of what looks to be perhaps the new trend, at least in the intermediate term. So market could probably go up a few percentage points higher before it hit the top line here. And then if it has another correction, I suspect it'll be somewhere along the parallel of this lower red line. Now, the only risk I see here is that the trend is weakening in its strength. So you can see a little bit of the trend, I guess call it 2 trends ago. Sort of this is the 2012 trend, the very tail end on the lower left of the video. And that had almost the exact same trajectory as the new trend. It started late 2011, lasted all the way until about June of 2000, started in 2012, the first one, pardon me. This most recent, the blue lines going up, those were from late November of 2012 until June or so of 2013. And what now appears to be a possible new trend is this series of red lines. And so you can see it's obviously on a totally different sort of axis. It's not at the same pitch. And the reason why that's not such a good thing is it creates sort of a negative divergence. You can see that down here, this new part of the chart. I can't draw a line in on the fly, but the strength of the market, even though it's going up and it's creating new highs, it's doing so on lower volume. So it's creating a negative divergence. The market's up, but it's going up in a much weaker fashion, if you will. So eventually what will happen is some point we'll finally see this thing break. It's almost an anomaly to me that the market could go up 20% in a year with really no incredibly good economic news, but that's exactly what's happened. So we just have to be patient, enjoy the good times while they're here, but make sure that our sort of fingers on the trigger, if you will, and if things start to break and these trends start to reverse, because you'll see them get weaker and then weaker and weaker, that's usually the sign that the long-term bull market is over. This may just be the very first little bit of weakness, and this market could keep going up for a while, but all the more reason why it needs to be watched closely. So that's what I hope to be doing for everybody, and I'll be back in touch, obviously, if this new trend starts to become realized. Make sure I report it, and if I'm wrong, and it's something entirely different, obviously, I'll be sure to share that information as well. So that's it for today. I hope everyone's having a good week so far and enjoying the sort of rolling in of the fall season. I'm not sure if I'll be back online this week, but I do know I do have scheduled next week my recession probability analytics update. So we'll kind of get an economic update, see how healthy the economy is, and also have just a couple more educational posts that I've been working on but haven't quite had the time to get online. So hope this video suffices in the short term. Thanks again. Have a great day. We'll be back in touch real soon.